Welcome to Investors Insights, episode number 144. Today we will be discussing Made in China. What does that mean to your portfolio? And if you like what we have to say, let us know. If you don't like what we have to say, you probably will let us know. And that's what we enjoy. We appreciate your comments, opinions, and we love the debate. I also want to encourage you to connect with us on Facebook, Twitter, and LinkedIn. And links are on our blog. So let's jump in and see what's happening in the big picture and in the world.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy Team at 5 Plan Partners. 3, 2.
Hi, guys.
Morning.
I had a great meeting earlier, and the dialogue was fantastic. I had to use the phrase "made in China." Growing up, I remember when people used to say, "Oh, it's made in China. It's not worth anything. It'll fall apart." I remember that phrase. Today, China has a whole nother meaning as we see the impact of the Chinese stock market as well as other things going on in the world. So last week, as somebody that's been in the business 34 years, last week was a painful first week in January.
It was.
Bobby, you did a really good recap earlier this morning. Kind of talk about that for just a minute.
Yeah, we started the year off on the wrong foot. Both the Dow and
could you be blunt?
it was ugly.
Yeah.
So both the Dow and the S&P 500 ended the week down 6%. Now that's the worst 5-day start to the year for the Dow ever, and the worst for the S&P 500 since 1927.
Yeah.
And so it was ugly. And so you mentioned it about China.
Sure.
China had to halt their trading twice last week. Trey, I know you're going to go into details on that. And then oil continued to plummet on supply issues. Oil was down to $33, and today it's continuing to fall.
Right.
And so
But can I say this, is that we said at the beginning of last year that oil prices could go as low as $20 a barrel. And we continue to go on that track. So in our projections on that, we've been on track there.
Yeah. There was some positive news. The jobs report on Friday handily beat expectations. I know, Ash, you're going to talk about that in more detail. And so looking forward to this week, China started today off on the wrong foot again. But we're looking okay in our markets. And so what we're looking at this week is earnings. Earnings kick off the season. And, right now expectations have been lowered for earnings. And so what we're looking for is some surprises for them to beat expectations. And then so last week can be we can put the last week in the past.
Yeah, I mean, we've talked about a lot of international things last week, but the reality of it is you haven't heard a lot of negative news about the U.S. economy.
That's right.
Correct.
All right?
Right.
But the media has pounded on that about this country could impact us, this situation could impact us, but the reality is our economy continues to move on. Now, talk about China for just a minute,
Yeah,
right?
so China,
does it really impact us?
that's one of the things. China could actually impact us. It could create opportunity, impact us positively. So, what happened last week is China had circuit breakers on. Any with downturn.
Talk about that.
Downturn of 7%, the market stopped trading. And so one day it lasted 30 minutes. And so what happened, that became a self-fulfilling prophecy. Once the market was down 3 or 4%, everyone assumed it would go to the circuit breaker, panic selling. And so they've removed that. Also, one of the leading causes of last week's volatility in China really wasn't the bad economic data. It was, so back in August, China put restrictions on large shareholders and said you can't sell anymore. They put that; those are supposed to come off earlier sometime this month. So the small investors trying to get ahead of that, thinking the large investors were going to unload, started to sell into the year.
Right.
That has now been put back on. Large investors can't sell out of their positions. That to us that seems like a very restrictive economy. And you might start seeing, as we saw in the middle of last year, money come to the U.S. from China.
Right.
And what we've seen through the third quarter of last year, $179 billion in financial assets, that's individual financial assets leaving China.
Right.
And so then add to that $663 billion of foreign reserves that the Chinese government has had to spend to hold up their currency, which is weakening. So a weaker yuan helps our imports from China become cheaper, which helps our U.S. consumer. Also, the money flowing out of China and into U.S. assets will help strengthen our assets. So it looks like, that's kind of how we could decouple from China is they come back, be more restrictive, money leaves China to avoid the restrictions, kind of helps comes to the U.S. where you get the most
The products
liquid.
are cheaper.
Yeah, their products are cheaper.
So,
helps
so
our
are
consumers.
we saying here? Are we starting to see a theme that it's the power back to the consumer? In other words, if oil prices continue to drop, lower gasoline prices. Also, from the standpoint, products from China
Become
could cheaper. The consumer's dollar, you got a strong dollar as well. Consumer's dollar could reignite inflation. Is that a good hypothetical
Yep.
there?
Yes.
Everybody like that?
Exactly. You got market overreacting to emotional situations, not really fundamental situations.
Right. So which what you're really saying is that even though valuations have come down, there may be some great
There could be some
opportunities
good
here.
opportunities.
That's well said.
Right.
Ashley, talk to us here.
Yeah, consumer confidence,
Yeah.
to piggyback on that.
Right.
A major reason or two that consumers feel confident and markets rise is that they are working
Yeah.
and their real estate values are good.
Right.
We were very excited about the quantitative number on the job growth, 292,000, as Bobby said. That was well over expectations.
And that was a good number.
It was an excellent number. And then what we talked about this morning is, and we want you to know, this is a quality growth as well as quantity growth. When you get to the end
Well
of the
said.
year, you feel like, well, maybe it's in retail, it's in service.
Just
makes
Christmas
sense.
holidays.
Exactly.
Right.
And you did have some of that in that 37,000 number
Right.
of 292. But when you click down that, you had 73,000 added in business and professional services long term. You had healthcare add 39,000
Sure.
long term. You had construction, very exciting, adding 45,000. But what's great about that is that it ended the year having in 2015, to go back to quants for a minute, we had 2.65 million jobs in the U.S. in 2015. That was just slightly below 2014, but it's two very good back-to-back qualitative and quantitative years.
Right.
That's bound to start translating into consumer
Sure.
confidence, we feel.
Right, absolutely. Yeah, well, I think it's here where we say we have to use the FDR quote, that basically the only thing we have to fear is fear itself.
Yes.
There's a lot of great information out there and opportunities. Also to our clients this past week, we sent out a letter that basically talked about our three themes for this year: women, wealth, and wireless, and what we're looking at opportunities there. And we're going to continue to pursue this consumer confidence issue where we see the consumer going into action and how that can impact your portfolio based on the economics, the positive economics it can create. So we appreciate you taking time out of your busy schedule to listen to us. We also ask if you have a friend, a colleague, family members that you think would find this valuable, please forward it to them. We appreciate those of you that have done it. And then keep those emails and phone calls coming, and we'll keep you updated. Thanks again.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.